Hey friends, I am back. I wanted to share a strategy today called the Strangle. It's a very simple options trading strategy. If you're new here, my name is Oliver. I travel the world and trade options. I support all of my travels through my trading. And yeah, so today I want to share a new strategy I'm going to be using. It's a very simple strategy, but it's not maybe a beginner strategy. This is for traders who have a little bit of experience in the market and are comfortable taking losses. Because if you freeze up and you don't take losses, this strategy can run you over pretty badly. Anyway, before we get into it, as always, I am not a financial advisor. I am not giving you advice on what you should do with your money. This is just YouTube. I have no idea what your financial situation is, your account size, your experience, other sources of income, like none of that. So I can't give advice. Definitely talk to a financial advisor. But if you're interested in options trading, you want to follow my journey, please subscribe. And if you find the video helpful, a like would be great. So let's get into it. Now a strangle is very similar to a strategy I shared before called an iron condor. I did a whole video on that, so I don't want to rehash the whole thing. But essentially, an iron condor is a bet that the market will stay in a particular range. So this is the SPY, which is an ETF. It's a fund that is a basket of the S&P 500, right? So it's like an index fund. This bottom line is the price. Today is May 8th. These are July 19th options. So in the next like 2 months and change, if the SPY remains in this range from like 490 to 550, then the trade will make $188, right? If it blows outside the range, then it loses $812. That's the basic idea. And statistically, in my testing and in other people's testing that I've seen, being a net seller of options tends to have a little bit of an edge to it. So over time, some will win, some will lose, but over time, this trade will tend to make money based on what I've seen. Now, that's the iron condor. It's selling a put and selling a call below and above the market, and then you hedge off your risk with a long put and a long call further away, and that caps your maximum loss. The puts that you sell, you collect money for, but most of that money actually goes back out the door to pay for these longs. So the idea of a strangle is you just sell the put and the call, and you don't buy the hedges, but you monitor the trade, right, and you manage it aggressively. So you need to obey your risk. If you have a stop loss, when you hit the stop loss, you need to get out. And yeah, like I said, not for brand new traders, I think, so much, but this is what it looks like. And you can see that this trade makes $473 at expiration within that exact same range. So it makes 2.5 times the amount of money, and it only needs half the contracts. Now, because you don't have to spend a whole bunch of money to buy the longs to cap your risk, you can actually push the range further out in both directions. So you can have a much wider range that will actually pay off more money than the iron condor. And so that's kind of the better trade-off. So here's a strangle all the way down to 470 and all the way up to 560. We make $238, so still significantly more than the iron condor. And you keep an eye on it, and if you're losing too much money, then you cut your losses. So my rule of thumb on these, much like an iron condor, I throw them on, and half of the max profit, I'll just take the money and run. So this makes about $240. So if I was up $120, I would just get out. And then my max loss is double the credit. So if the trade was down about $480, then I would take the loss. I would lose $480. Now the one thing to note, if you have a Reg T account, most option trading accounts are Reg T, the margin requirement on a strangle is much higher than the margin requirement on an iron condor. So that's another reason people tend to prefer iron condors. There is a workaround, which I will talk about shortly, but that's pretty much everything you need to know about the basic strategy. Okay, so what about me? So in a previous video, I shared a rough breakdown of my portfolio of options trading. I do other things, but the options trading is like 80% equities options in SPX and RUT, which is the Russell and S&P indexes, and then only 20% was in other markets. Actually, gold and oil is what it is. Now the S&P and Russell trades, I was actively managing delta all the time, and I try to keep gamma relatively low, but I'm still not super comfortable having that much of big of an allocation on the account just in equities. I'd rather have a broader collection of underlyings, right? So there's that going on, right? But I like trading futures options because, like SPX and RUT, which are index options, futures options get a 60-40 tax treatment. So 60% of your gains from futures options are taxed as long-term capital gains. It's really appealing. The tax reporting is also a lot simpler. It's a single line item for your P&L for the year for all of your index options and futures options. The catch is when you look at the futures options chains, so it's things like gold and oil, which I'm trading now, but also you can do bonds, the euro, corn, silver. Like there's a bunch of different markets that you can trade, but just the way that the pricing is and the strikes, I don't feel like you can do iron condors on most of them, right? But strangles are very viable. So that's why I'm moving to strangles, because I want to trade futures options as my product to diversify into other markets. Iron condors aren't really viable there, so I'm going to go with strangles, right? Now on the plus side, futures options use something called span margin to tie up buying power. Normally, as I mentioned, if you traded something like SPY, the buying power something like this would take up is significant. Don't look at this number. It's going to be something else. This isn't direct T account, so these numbers aren't really relevant for you. But it's going to be some really, really big number, and that's why a lot of people don't like to trade. That's one reason a lot of people don't like trading strangles. But in futures options, the margin is much more efficient. They give you a much better margin treatment for your strangle trades. So that's another reason to trade futures options with strangles. So here's what I'm going to do. Each month, I'm going to try to have maybe like 5 of these positions on in various non-equities markets, like like bonds, like corn, and I'm going to take 50% of the credit as my profit target. 200% of the credit will be my stop loss. I'll have up to 2 overlapping, so I can do, and I'll put them on at 90 days. So I could have, if I have one already on at 90 and I want to put another one on, I'll just put it on at 120. But 90 feels like kind of the sweet spot. And the reason I like to go longer dated, by the way, and I'm going to use 8 delta. So the further out in time you go and the lower delta you go, the more it pushes these shorts away from the market. And the farther away that you push them away from the market, the lower the margin requirement with span margin will be. So there's an advantage to pushing it out in delta and time, but also longer dated, lower delta options, I feel like they tend to be cleaner. So I prefer to trade them anyway. So 8 delta, 90 DTE. If I want to put a second cycle on, I can go out to 120. And yeah, and I'll just manage at 50 or 200 and keep it really simple. There are a lot of really clever management rules. You'll hear people talk about rolling the untested side, rolling for duration, this kind of thing. People can get kind of cute. I feel like, if you're experienced with strangles, that can be fine, but honestly, I think you're usually better off just taking the loss. Some trades are losers, and the sooner we all get over that, the better our trading tends to be. Now, as far as risk management, I'm going to be targeting 1% of my portfolio as the total credit in each cycle, but I may layer into the position over multiple entries, and those entries I may use different strikes, because 8 delta may have moved, but also if the trade has accumulated a little bit of delta, I could skew the delta on the second layer, to flatten things back out again, basically like a free adjustment, right? So yeah, that's going to be the plan. I have a couple of these on already. I have moved over to Tasty Trade. I don't want to talk too much about brokers today, but Schwab is fine. I like Schwab. There are various personal reasons why I've moved over to Tasty Trade. So I have a couple of these on. Soybeans is giving me a bad time, down 100%. So hey, maybe one of my first trades will end up being a stop out, but that's okay. So yeah, we'll see how we go. Now, I would mention, if you're interested in watching a heck of a lot more videos on futures options and strangles, there's this channel, Tom King Trades. He does a lot of these. He uses a little bit different deltas than me, and he looks at RSI and does a couple of other things that I don't do. I don't like everything he does, but I think he's, it's a solid channel. He has his style of trading, and I have mine, and you might want to check it out. Definitely worth a look if you're considering trading futures options, for sure. Anyway, that's it. That's the strangle. It's a very simple strategy. I'll let you know how it's going as I trade it along, and yeah, like, subscribe, and I'll see you guys in the next one. Cheers.